Hello, guys. I want to introduce you to my option strategy calculator. As I'm learning about options trading, I decided that one of the best ways to increase my knowledge was to build my own option strategy calculator so that I can get a more thorough understanding of how each of the option strategies works. And now that I've got it built, I built a very simple one on Google Sheets. I wanted to share it with you so that if you find it useful, you can use it as well. So I'm going to show you around, and I'm going to use a few examples. Generally speaking, any cells that are colored in blue are cells that are updated automatically, and any cells that are colored in green are cells that will need your input. So let's start with selecting the ticker that we want to explore options for. I've got a bunch of tickers in here. We're going to start with a very popular one, Apple. We select the ticker, and that will automatically populate the pricing data. So that's the current price, and that's last year's price in a small chart. And then we have a bunch of fields to select the characteristics of the options that we're looking at. So first and foremost, the strategy that we want to apply. In this case, we're going to look at a simple long call option to start. We're going to select the expiry date, the 19th of June. We also have fields like the dividend yield, the risk-free interest rate that are used to calculate the fair price of the option. These will need to be updated manually as well. And then we also have contract size and the transaction costs. I have contract size at 100 shares by default. It is the most common contract size for options, but it can be changed. And then transaction costs, which will depend on the broker you're using, but it can be changed as well. So whenever you select an option, these fields that you're seeing here, the leg, the direction, the type of option that we're buying, and an example of strike price will populate automatically. So in this case, we're buying a long call, and we select a strike price of $310, and we buy one contract, one option. The first thing we do is we calculate the fair price using the Black-Scholes model, so that we get an idea of the price that we're going to have to pay for these options. But then we also have the option to add the price that we actually have to pay in the broker that you're using. So we know that option pricing is normally higher than what the fair price should be. So in this case, for convenience, I'm just adding a 5% over what the fair price should be, but you can change this field to whatever value you want. Now, once you've selected all these fields, then you can analyze the potential profit, potential loss of your option strategy. In this case, because we're buying a long call, we're net buyers, so we have an initial debit of $1,666. In the case of a long call, the initial debit is also the maximum loss at expiration. So if the stock moves in the opposite direction to what we think, the maximum loss is capped. Maximum profit, in the case of long calls or long puts, there's no really maximum profit, because the stock can move high, and theoretically there's no limit to how much high it can go. But based on the volatility of each stock, what I calculate is the potential maximum price that it could reach during this time period. In this case, based on last year's volatility, Apple could reach a maximum price of 432. And if it did reach this price of $432, then the maximum profit at this price would be $10,000. As I said, this is just an indicator of how much you can make. But in the case of long calls, long puts, and a few other strategies, it's not as relevant. Let's go and see another example. So let's select Twitter. And you will see here that when we select a new stock, you need to wait a little while so that the pricing data loads. This is a feed that comes from Google Finance, so it takes a little bit to populate all the data. We get again the current price, the last year's price action, and if you notice here on the top right, there's strategy suggestions that are based on the volatility of each stock. So for stocks that have high volatility, we suggest different bullish, bearish, and neutral strategies. For stocks that are that have a lower volatility, we suggest bullish and bearish strategies. Let's have a look at Twitter, and let's select, for example, short iron Condor. And as I said before, when you select a strategy, the fields in blue populate automatically. So in this case, we have 4 different legs that we buy or sell in a short iron Condor strategy. Let's go ahead and select the prices. So let's say that we buy a put at $20, sell a put at 24, sell a call at 34, and buy a call at 38, and we buy one of each. So this will give us the fair price. As I said, I've got this to update automatically, but you would be able to change the prices that you would pay in your broker. And now we can again understand the strategy. So in this case, we would be net sellers and have an initial credit of $85. The maximum loss at expiration would be $314, and the maximum profit would be $85. And because we're talking about a short iron Condor, we're neutral when it comes to the stock price for the next month or so. And we have 2 break-even points. So on the low side, as long as the stock is above $23, and as long as the stock is below $34 on expiration, we would make a profit. Anything that's under 23 or over 34 would be a loss. And as you can see in the chart, we would get to the maximum loss, which is capped at $314, if the underlying price is under $20 or over $38. So we have a decent margin to make a profit here. Let's look at another example. So we've looked at a bullish strategy, we've looked at a neutral strategy, let's look at the bearish strategy and see how the calculator would work. So in this case, let's go ahead and select Google, and again wait for the price to load. So here we have it. It's currently trading at $1,300, almost $1,400 per share. Let's select bear strategy. So in this case, let's go and select call diagonal spread. And the call diagonal spread has only 2 legs, so we can get rid of this. Now the call diagonal spread adds another element to the option strategy, which is that we buy or sell options that expire at different dates. So as it says here in the description, for every single, by the way, for every single strategy that you select, I have a short description. That in this case, it's taken from Options Alpha, which is one of the resources that I've used myself to learn about options. So I get the definition of what that option setup should look like. So if I go by the definition, it says that we should sell 1 out of the money call in the front month. So that's the option expiring on the 19th of June. And we should buy an out of the money call in the back month at the highest strike price. So what we can do is we can select a later expiry date for the second leg. In this case, we select expiry date of the 12th of June for the first leg, and expiry date of on the 17th of July for the second leg. And let's go ahead and add the pricing that we would like to sell and buy at. So let's sell 1 call option at $1,400 and buy one call option that expires in the next month at $1,480. And let's wait for the chart to update, and let's go ahead and analyze this position. So in this particular case, these options should result in a net debit, but with the setup that we've got right now, we would open this strategy with a net credit of $442. The maximum loss at expiration, this is a bear strategy, so if the stock was to move up, then the maximum loss that we would incur would be $7,558. The maximum profit at expiration would be $3,610, which would be around here. And if it went, that would be around here, that's around $1,400. If it went below this level, we would still make a profit, although it would be lower. But that's why it's a bear strategy. So that summarizes a little bit the tutorial. There's many other options that you can explore in here. I've got a few stocks as well that you can explore. I'm gonna make these available for you guys to use, and I hope you find it useful, and I hope that if you do find any areas that have inaccurate information, that are broken, that are not working correctly, I would appreciate as well if you let me know so that I can improve the product. I would also appreciate any suggestions on how to improve this calculator further. So that's all for me today. Thank you very much.